Let's bring in Stephen Whiting, Chief Investment Strategist at Citi Global Wealth Management Investments, and then Peter Boockvar, Chief Investment Officer at Bleakley Financial. He's also a CNBC contributor. Gentlemen, thank you both for being here with us. Stephen, I'll maybe throw it out to you first. Leon Cooperman, he says what he says. He's got a view. Is this the right time for people to be feeling a little safer about the markets, or is there still caution to be had?
Look, when you've had some negative events and there's a lot of apprehension, the rebounds from this can be fairly strong. Yet at the same time, what we think is that the economy has a price to pay to keep the Fed on hold, right? If you've taken down the expected Fed funds rate for mid-year by 100 basis points, right, there should be something that's going on here. And we think, again, markets are pricing in probably too high a probability that we can have strong growth and Fed easing at the same time. So these are concerns for us, particularly when we look at the mid part of the year, the April through June quarter, where earnings estimates show a sharp rise from the first quarter. We think that the economy is going to be in a lull in that period. And if it isn't, it can bring the Fed back in.
So Peter, the interesting disconnect here is markets versus maybe you could argue some of the economic data versus where you could argue the Fed wants to be in terms of policy. Is it dire? Should we expect material weakness in the economy? Who's got it right in this situation?
Well, I think it's not going to be dire, but we're on the cusp of a recession, if not like in one. And the banking situation just tips us right over because of the presence that small and mid-sized regional banks have in lending to small and medium-sized businesses. So the economy was on a fragile state to begin with. And if you break it down, U.S. manufacturing is in a recession. Housing essentially is in a recession. And capital spending is slowing. So it's just the consumer that's sort of holding things up. But even the consumer is now bifurcated, depending on where you are on the income scale and how sensitive you are to this trend in inflation. So to me, it's going to be a messy earnings season. We're going to see continued degradation in profit margins, which would then lead to potentially a pickup in firing as companies try to regain some profit margins. That's the next shoe here. We've seen layoffs in tech. Is McDonald's the beginning that, okay, maybe there's some rationalization, even though it's small for McDonald's, but other companies are going to start to revisit their labor forces? So there's a lot to play out here as the year progresses in the economy.
One of the things, Stephen, over the course of the last several weeks that many traders have been taking note of is the real outperformance in the NASDAQ so far year to date versus, say, the Russell 2000 small cap. OK, and they say that divergence, if you show a chart of the Russell 2000 versus the NASDAQ so far this year, it tells you a story about where the fear is and where the economic expectations are. Small cap companies don't fare as well in economic downturns. Is that what we should expect? Does that market have it right?
Well, that's where we're positioned. If you think about leveraged cyclical companies, companies that don't have the resources, again, on their balance sheet to survive a cycle, you would find that a lot of them are smaller cap companies. And if you'd find those that have the strongest balance sheets in some non-cyclical industries, you'd probably want to migrate to large cap software, for example.